there could be a bank discussion and then a separate Wells Fargo discussion. I mean, Wells Fargo has been the underperformer in the sector. It entered the pandemic in a much weaker position with declining revenues and a bloated expense base, and it's got a lot of regulatory issues. As a former CEO, presumably as a shareholder, Dick, how much work does Charlie Scharf, the new CEO, have ahead of him?
Well, I really don't know the answer to that because, I've been gone now for 14 years. But from what I read, they're working primarily on fixing the issues that they have with the Federal Reserve. And that focus is probably, and the asset cap is causing revenues to continue to decrease. And so you have increasing expenses and lower revenues. That's not a good position to be in. And hopefully they are working to change those things.
Yeah. You're still a shareholder, right, Dick? I mean, is that
I am.
It's a correct. OK, so as a shareholder, why do you, I mean, you've been out for 14 years, so you have the benefit of being sort of this outside, slightly impartially. I'm sure you still have some partiality to Wells Fargo. But why do you hold on to the stock? I mean, are you banking on this turnaround? Do you see that coming as a shareholder?
Well, yes, I think it will come. I think there are fewer shareholders because they cut the dividend so much. And I think for a long time, that was a reason to wait for the turnaround, because you were getting paid to wait. So I think they lost a lot of long-term shareholders when the dividend was cut.
Dick, it's David Faber. I don't remember seeing a group quite this out of favor for this long in a while. I don't know about you. I mean, is it all just about rates at the end? Even Goldman Sachs, which, as Wilf indicated, had quite a strong quarter, really isn't doing much of anything as a stock. It's not down nearly as much as some of the big banks. But does it just all come back to rates?
Well, it doesn't come back to rates. The rates are low because there's a lot of uncertainty about the economy, and those are related. And certainly, as the Fed has said, that they're going to keep rates low forever, even if the economy improves. So that's a negative for banks. And, you can talk about trading revenues, and certainly they've been good. But the market has never paid for trading revenues. It's too unpredictable. It's too volatile. So, you may get a 50 cents or $1 pop because of trading revenues, but no one is going to invest banks for a long time, at least in my opinion, and I certainly would, based upon trading revenue. You've got to get back to non-interest revenue other than trading, and you've got to get net interest revenue. And net interest revenue is going to be a problem as long as the as long as the Fed keeps interest rates low. Now, hopefully, the margin has reached bottom here, or pretty close to bottom. But the only way you're going to get if the margins stay the same, or maybe even go up a bit, the only way you're going to get more net interest revenue is by more loans. And you're only going to have more loans if the economy is strong.
Right.
And I think that gets back to, we've got to get a vaccine so that there's some certainty that we're going to have a turnaround in the economy and more employment and so on. So a vaccine, I think, is the most important catalyst to see bank stocks, which are, you're absolutely right, the lowest they've been for the longest that I can remember, back into a good spot. Now, another problem is that the Fed is still considering, supposedly, eliminating dividends on banks. And so one of the reasons, again, that banks have held up to some extent through all this is that they have a high yield. And so I think it's a very negative thing that the Fed is doing. Either do it or don't. But don't let it go. It's
don't
bad
leave it
for
all
the
in
economy,
abeyance.
and it's bad for economic confidence.
Shepard Smith here. Thanks for watching CNBC on YouTube.